In 1980, a band called The Vapors had a hit. I know Stuart Sopp knows this. The name of the song was Turning Japanese. Turning Japanese was the song. I was in high school. I'm like, what are they even talking about, turning Japanese? But oddly enough, a lot of things that have happened over the last couple weeks leads me to believe that here in the United States, we might be turning Japanese. By the way, you're listening to the On the Tape podcast. I'm Guy Adami, always joined by Dan Nathan. Danny Moses of Big Short fame. He's in Europe. He's in Italy, I believe, right now. Is that right?
You just doxed him.
I did what?
Doxed him.
I don't know what this means. We talk about this
almost every show.
So what I just told people is, is somebody going to get on an Alitalia flight and go find Danny Moses? I don't think that's going to happen.
Half of New York City is in Italy right now.
Maybe more.
Yeah.
On this On the Tape podcast, we're going to be joined by co-founder of Current, Stuart Sopp. And in the second part, we're going to be joined by the CTO, that's Chief Technology Officer and co-founder, Trevor Marshall. And we're going to talk all things tech in the fintech world. But Stuart, you heard the way I set this up, and on Wednesday of this week, you and I met in your cafeteria. By the way, if you haven't been to the Current cafeteria, it's unbelievable.
Don't dox us.
What is this docs again? I'm just saying it's beautiful.
We'll put it in the show notes, guy, because we know
Stuart
that you know
said,
how to
listen,
find
I have a meeting in 2 minutes. What's going on? I'm like, holy shit, this bond market is crazy. I said, you see what's going on? And I said to Stu, I know you watch these things. I think dollar-yen, I think the dollar is going to explode against the yen. I think the yen is going to continue to sort of fade away. And if you watch what's happening in the Japanese bond market, their so-called yield curve controls, which have been in place for a long time, they're losing control. And that's something Danny Moses was talking about a couple weeks ago. So as we watch 10-year yields in this country go back to 4.2%, the bond market seemingly off the rails again. From 30,000 feet, what are your thoughts on this, Stu?
My favorite height. Thank you for having me. It's been an eventful bond week, hasn't it? So as you said, JGB's kicked it off. I thought the BOJ was doing a damn good job of doing yield curve control over the last few months. I thought they did a really good job of that. It was exceptional. Obviously, they've started to lose control.
Well, that's it. So I'm interrupting you. I apologize. But it's one of those things like they do a good job until they can't. And once that genie's out of the bottle, things start to move very quickly. And you saw, I think we're at sort of a 9-year high in yields over there. And that's happening right before our very eyes.
Yeah, and there's contagion, you can see. So, most earnings are being overshadowed, I think, by the macro environment. We've had Bill Ackman come out. Obviously, from what I know, I have no proof, but I heard he was in the short end, shorting, 2 years, rolled it into the 10 and 30, and now he's out on Twitter sort of spruiking his position, seemingly going against the Fed. I think, where he's probably coming from is inflation's sticky. The soft landing may not happen, and so can with the 1.85 trillion of debt that's being issued over the next 6 months, can the Fed really hold this market together? And so they've seen Japan, now they're looking at the US and sort of having to go at the long end. And obviously the Fed doesn't control the long end. 10 and 30 years they don't control it unless they do yield curve control. So. And capital controls and all those things. So, we're in a sort of precarious-ish position in my view. So bear steepeners are on. That's bad for risk. So, of course, dollar goes up. So we've seen the dollar rally. We've seen euro dollar come off from the 111. We've seen cable sterling dollar come up from 128, 128-ish, a bit lower. The thing about dollar yen, and this is me going back to my old trading days of currency trading, the reason why it doesn't rip straight higher with the JGB market is what you're saying, is because now we have contagion, now we have a risk-off environment, and people have cross-yen trades on. They'll have Aussie yen, they'll have Rand yen, anything that has a yield, like Brazil yen, right? I'm sure Brazil yen, I don't know, but I'm sure it's like a huge trade, a huge long trade, right? And so now, those people are unwinding that. So you're selling Brazil, you're buying yen, but you're also buying dollars and selling yen. So dollar yen gets real cross-currented when you see the contagion on the first wave. Then eventually it sort of snaps back in and then you'll see it go up.
So we just had our first kind of big down day. That was Wednesday. We're recording this Thursday into the close. And, all of this volatility we've seen in currencies and in yields, when is it going to work its way into the stock market? We still have a VIX at 16.
I think you're right. I think Well, what I think I've been consistent on this year is the MOVE index over the VIX, the VIXI, or whatever you want to look at. And so MOVE index is bond market volatility. We see the bond market volatility first. It will then translate into equities. It's the tail of the dog on this. And so I think equity markets have just started that unwind. We just saw great earnings. Some big companies have good earnings, and I don't think it matters. Macro environment is just like overshadowing this because it's so big. It's just such a big event that's happening. So I think, at least in August, for the rest of this month, I think we've got, a decent retracement in the equity market coming. I don't think this bond market volatility is going to go away. And I think we're going to see more pressure on this bear steepener.
And we talked about this the other day on one of our market calls. August 2015, Chinese devalued the yuan. We saw some craziness in the ensuing months into the fall in global markets. And, that obviously had catastrophic impact. The yuan, by the way, is right before our very eyes starting to lose some of its luster. But my concern, and I'm not saying Japan is nearly the economy that China is, that's not my point, but you start getting into potential currency crisis, things start to happen really quickly. And you said, you're right, the Bank of Japan has done a great job, I would submit, up until this point, the same way our Federal Reserve, a lot of people would say, has done a great job. But it's the dismount and it's sticking the landing that's important. And we're not at that point yet. And that's been my concern all along, Dan, in terms of our Federal Reserve. So, maybe speak to that. Everybody seems to think we're going to have this neat little end of year, soft landing, everything's going to be fine. But under the surface, things are getting a little messy.
Yeah, currencies are interesting. There's so much money and so many options and so many derivatives out there that currency markets have really been quite stuck, in my view. Right, you need some material liquidity event to get them going. I think what's happening is, you remember Yellen went to China?
Yes.
Right, she went to China and she started saying positive things before she went. Like, China's now a friend. She did the sales trip, because she knew $1.85 trillion of issuance was coming. She's got to sell some. She's got to shield some bonds.
You need a buyer.
You need a buyer. So she clearly went out there. Fitch, as she returns, downgrades America and said it was deeply unhelpful. There's obviously some politics going out there in some way. I'm also looking at the dollar Hong Kong peg and things like that. There are games behind the main game going on at this point that I am not privy to, but there is something happening, right? So there's this clear sales trip that's happened. Fitch are doing something a little odd to me. Like, they're definitely not in line. So I don't know what's happening there. And I think, like, in general, to get a crisis going, you need sort of tectonic shifts. You need plates to shift. And I'm starting to see political or sort of macro geopolitical plates starting to shift. So I'm with you on that. I'm uncertain how to pin it at this point. I don't have enough data on it.
So let me ask you about shifts, because I'm with you on the Janet Yellen thing. She had something to sell. She made the sales pitch. Earlier this week, I saw a headline that the United States is giving about $350 million of military aid to Taiwan. That's a giant FU to China, without question. If you watch Kyle Bass or listen to Kyle Bass or read his Twitter or whatever they call it now, he's pretty convinced that something's going to happen there. And I think earlier this week, I don't know if it was the founder of SoftBank or somebody in China talking about, and he used the word catastrophic impact it would have if something between China and Taiwan were to sort of rear its ugly head. And to me, you talk about all the existential risks out there, that's on the leaderboard on my list right now, Stuart.
Yeah, I'm not a scholar on Congress and how money gets apportioned here, but it sounded like Biden, the White House, and the administration went around the normal controls. Right? It sounds like they found some sort of slush fund to give them $300 billion. So this is a White House that really likes war, right? That's clearly, they're starting to put us on a war footing. Did it with Russia through Ukraine. Now it looks like through Taiwan. From all the intelligence and reports I've read, China doesn't want a war with America, a kinetic war, because they'll probably it's not good for business for them. And so I'm just wondering, we're trying to sell bonds. Do we need a war, right? And so I'm unsure I think there's a lot of posturing, but to me, if China doesn't want one and we need them to buy our bonds, let's see how this next 6 months.
So you think this is a lot of brinksmanship that will lead to nothing?
Yes.
And there's a school of thought that is in your camp 100%.
It feels like that. We need them right now. It would be catastrophic for supply chain. Like we're still heavily reliant, even our military, the U.S. military, heavily reliant on the Chinese supply chain. So I don't think it's in anyone's interest. I just think it's an administration posturing thing for whatever reason. And I'm just not privy to why they're doing that.
So we're going to shift gears. You a Formula One person?
I am. I love Formula One.
Like Emerson Fittipaldi. Remember that guy?
Yeah, I do.
I mean, he was why are you laughing at me? Emerson Fittipaldi is like a legend in the Formula One. Jackie Stewart.
I met him.
So you stop it.
I have, yeah.
He is. He actually is a great man. He actually, a lot of the safety measures you find in F1 now were put in place by Jackie Stewart.
Yeah.
Little known fact. Why are you looking at me like that? It's true. You're amazed that I know these things. I mentioned shifting gears because let's shift gears into some actionable stuff here. And again, Dan, right before our eyes, you see oil starting to, rear its ugly head yet again. And a lot of these energy stocks, which a lot of people left for dead earlier this year, they threw them by the wayside to get into these high growth, high valuation tech names, are starting to get back on their feet again. So Stu, you look at this, again, the macro world, but you get a little granular and you see some of the things that I'm seeing in the energy space.
Yeah, I think oil specifically, that gets kind of macro, right? So we tried to fill the SPR and the Strategic Petroleum Reserve, and Saudi cut another million, right? And so we saw that dual release of information, one day and the next day. So here we are at like 80 odd bucks. I think growth is slowing, but maybe not to that point. And so like oil becomes a little tricky on that trade. I think nat gas probably comes off a little bit. It's stinking hot. I don't, there's not a lot of demand for any gas heaters, and we're killing gas stoves here in in New York apparently. But jokes aside, I think nat gas comes to like $2.30 somewhere there, and I'd be looking to pick that up for into Q3, end of Q3 into Q4. But oil, I'm standing away from right now.
All right, let's talk about Bitcoin. We haven't talked about Bitcoin in a while.
The Bitcoin.
And so this is really interesting. I know that this is a market that you look at fairly closely, and it's been amazingly stable, when you think about it. It's been like 2023 has been a bit of a stair step, right? You had this big move higher. It was like a YOLO in January. Everything was working. Everything that got killed in 2022 started working in January, right? And then it kind of pulled back, and then it had this move from 20,000 straight to, felt like, 28,000, consolidated there, pulled back, and then it went from 26,000 straight to 32,000. It's pulled back a little bit here. So we've had this kind of stair step sort of action. What do you think some of the biggest drivers right now are? And again, I love it because no one's really talking about it right now. And I wonder if you see that as a bit of an opportunity. Also at a time where, again, we just spent a little time talking about geopolitical sort of things here. We talked about the volatility in the dollar. We've talked about inflation, that sort of thing. What's the bull case, Stu, in your opinion, right now at, near $30,000 for Bitcoin?
Yeah, the bull case is relatively easy for me, I think. Larry Fink of BlackRock has finally, and I say finally because in the crypto markets, we've been talking about, BlackRock, a big player coming into the market and enabling distribution for many, many years, like 4 or 5 years, something like that. And so he's talking extremely bullishly and about crypto in general. I suspect that he's got real estate that he wants to tokenize. I suspect there's other reasons why he wants to get into crypto. But he's also talking extremely bullishly about Bitcoin, which enables trillions of dollars of access to that liquidity. So there's a very clear case there. You got Michael Saylor, who's just literally, even with rates where they were, just issued a bunch of debt and bought a ton more. And I think when you look at like this, all the macro events that we've thrown at it this year, I think we've seen the low. We saw like the FTX unwind and all that other stuff. I think we've hit, 28, 30,000, like you say, it's when it's stable, it feels expensive. But I tell you, if this goes up, you're going to want a lot more of Bitcoin. I'm also bullish on like Ethereum and a tail of other alternative coins, altcoins, and that's mainly in the gaming space.
Let's change racetracks because we shifted gears before.
Yeah.
Now we're going to change tracks. Maybe from a Formula One to like an Indy, where Indy you just go around and around in circles, right?
Yeah.
Whereas Formula One, you have a lot of turns and shifting. Banking sector, which is obviously something you pay attention to. A lot of these banks have done extraordinarily well over the last couple. Since earnings, for example, JP Morgan's gone from about 137 to 150 something, actually flirting with an all-time high. So the stocks have done well, but yet we find ourselves in a situation where regulation is absolutely coming. Tighter lending standards are coming. Maybe lack of demand is coming. None of those things are particularly bullish for the banking sector. I mean, speak to me about some of those cross currents.
I think the bullish case there is NIM, right? Net interest margin with Feds keeps hiking, and maybe has paused at this point, right? So the maybe this is the top. But they're just making money hand over fist. And then, of course, we blew up the small banking sector, as we all know, the crisis in the small and regional banks. And banks like SVB and First Republic and whatever have just been given really to everyone else. You saw HSBC had a record on the SVB UK, $1.5 billion of cash in their pocket. And of course, JP Morgan with their nice $5 billion lift or whatever it was. So you've got the cross currencies of like, hey, there's tighten up some of the loosest things, but then we've made the bigger banks stronger, right? Because there's been some gifts that have been given. And then the Fed is where it is. I mean, it's 5.25. I mean, this is old school banking, right? Like we're buying low and selling high in the interest margin. So I think they do well. I think, until the Fed rolls over, until core inflation really is properly crushed, it's a banking game, and then it will be a payments game.
Yeah, so we mentioned, Bill Ackman of Pershing Square and him shorting the 30-year. Okay, so he thinks rates go higher. And it brings us back to a couple months ago. Remember when Jamie Dimon was talking about the 10-year, and he said, this was when Fed funds was still below 5%. He said something like, you should expect to see 5, 6, 7% or something like that in yields. And so it's interesting what Pershing, their view is that the inflation is going to be at least the target rate, the downside target rate, and it used to be the upside target rate when it was below 2% pre-pandemic, is going to be reset higher or something like that. Okay, so talk to us a little bit about that, because in our conversation with Trevor that we're just previewing here for a second, we talked about a lot of the kind of excitement around the productivity of a lot of the these large language models, and generative AI is going to be productivity, and that's going to be really deflationary. So it's funny because there seems to be a lot of cross currents on this right now, and if you look at the data out of China, it's deflationary right now. So betting on higher inflation to me is not a great bet. Bringing it back to crude oil, back above 80, and you think about just how weak global growth is right now, despite the fact a shooting war between Russia and Ukraine. We just talked about the hundreds of billions of dollars that we're funneling to Taiwan, and we still are not seeing that seep into global growth. So I know this was it's not maybe much of a question, but it's something I think that really to focus on here, because either inflation is going to stay higher and rates are going to stay higher, or we're going to choke off a lot of growth here and we're going to go into a deflationary spiral, and that's just not going to be good for risk assets. It's not going to be good for banks that we're just talking about. And it's not going to be good for yields.
Yeah. Yeah, I think what you're getting at is the structure of do we have enough growth here to outgrow the inflation? And with all the innovation that's coming around, is that enough? Is it enough on the productivity? Is it enough on the innovation side? I don't think it's going to come quick enough, and I think we're going to go through periods of higher inflation, and then they'll settle down at a higher level of which we're doing now year on year, right? It's just, okay, it's low, but on an absolute level, we're settling higher. And so we're in one of those low periods right now, where everyone's calming down on rate hikes and all that stuff. But I don't think inflation structurally or materially is going to go back to those levels. And so, and that's because of deglobalization. It's because of energy insecurity. We don't have the right policies here. We don't have the right policies, in Europe either, in my view. And so I think for the next 5-10 years, I think some of these tech solutions are going to help on the cost side, but not on the innovation growth side. I don't think we're going to have that growth.
So as a CEO of a company, and you employ a lot of people here, I mean, what when you think about, how you're allocating resources, how you're spending money, that sort of thing, and inflation, was all over the place. It seems to be in less places now. It's still firmly embedded, I have to assume, in wages, right? Yeah. So talk to us, what are some of the things that you see as you're kind of mapping out your financial future in the next 6 months, a year, and how you're going to spend? Is it really just wages? Is that the stickiest part? Or are there other parts of your spend that you think about could have inflationary upward pressure?
Yeah, from a corporate standpoint, wages and shelter. So real core inflation stuff here. So New York is insane on rental cost. And that has like tricky implications for people in more transactional roles. Basically, if you're an engineer, typically paid very well, very productive. But even they struggle with some of the rents that they're seeing in New York. There's just not a lot of housing supply. And I think it's all been choked up given the dynamic of what's just happened in the housing market. And so I think that will be pervasive. I don't think people are selling their houses because they've locked in their rates. And I think we're not building any new houses, especially in Manhattan at least. And so you've just got shelter that's going to be sticky. It means that, the hybrid model, can you let people work from home and all this other stuff? It means it's going to be around for longer. We have full employment in America. It's sub 4%. That's not going away either anytime soon, I think. So I think that's, wages and shelter, that's really inferring from a corporate standpoint, my viewpoint on many businesses. I don't think that changes in many other companies or states.
What changed so much? I mean, like it seemed like there was a universal pessimism among the investor class, among the CEO class. I mean, this was at the end of last year, right? And so what do you think changed so much? I mean, like there was just a consensus that we were going to have a recession in 2023. And I'm just curious, like, investors, like they turned on a dime, okay? It seems like there's still some trepidation among the CEO class for a lot of the what you've just mentioned. So there's a level of cautiousness because they don't see wages breaking, you know what I mean, or they don't see downward pressure on rent and stuff like that.
Yeah, I think I share that trepidation. I've heard from Fortune 500 CEO types and CFOs that they're still worried. They're still worried about the economy and they're still worried about going forward. And I don't know. I think it's a lack of clarity. And so it's not because there's something happening that they understand. I think they don't understand. I think there is a massive gap of like what all this economic policy, macro and fiscal, is really doing to your sector, your industry, and to your employee base. I think it's just the uncertainty that is killing it. And then secondarily, notional prices mess everything up. Notional inflation, notional wealth. Like you may look like you're getting you're getting a wage increase, but your purchasing power could be down 10%. You get a 5% increase at 15% or whatever you could, fictional number you want to put out there, still 10% decrease in purchasing power. And so earnings can be very good in a high inflationary environment on from the top line, but the undercurrent and the structure of that business may not be that good, right? And so I think it's like the unknown with all these things that are happening, and then there's that notional versus real. For a lot of CFOs, a lot of CEOs, they're like, is it really that? I know I'm looking good, but I don't know if it's that good.
Before we get out of here, I believe, and you can correct me if I'm wrong, I often am wrong. I think there are 20 teams that comprise the Premier League. That's your soccer league, right?
Football, as we call it.
Football.
Yeah, because we kick the ball.
And some well-known names like in the United States and basically Yankees, the Red Sox, right? Those are the Cincinnati Reds. I mean, just there's certain teams, Los Angeles Dodgers. So in the Premier League, there's like Tottenham Hotspur and Arsenal and Chelsea, Liverpool, Manchester United.
Those are all cities.
Those are squads as well.
Yeah.
Okay. So those are all the well-known ones. And then there are obviously lesser ones. For example, like a Birmingham City. Why are you mentioning them? Because apparently Tom Brady threw his hat in the ring. What do you make of that?
He's clearly never been to Birmingham.
Exactly. My point exactly. What is he thinking? How the mighty have fallen, Dan Nathan.
Are you excited about Messi being in Miami and being in the MLS?
Yeah, I think, I am actually. I mean, you saw the first game they've gone, even I, this is a big thing because I'm not a big Messi fan particularly. I mean, obviously I can respect extreme talent, best in the world and all that stuff, but like I haven't really, I don't follow his career that much. I'm a Chelsea fan.
Sure.
So him going to Miami, even I was like, maybe I should book a ticket.
Stop it.
Yeah, I did. Yeah, I was like, maybe I should go and see a game. So if I'm thinking that, there's a lot of people thinking that.
Yeah, but let me ask you this. He scored a bunch of goals. They won 3 straight games,
Yay.
I think, right? They were like at the
were
bottom
they
of the
friendlies?
division. No. I mean, they're winning in their league. And I don't follow the MLS, but when I was watching the highlights on SportsCenter, I mean, it looks like he's just jogging around these guys. It seems like he's playing like a JV team or something like that. So it doesn't look like good. It looks like watching Ted Lasso lasso soccer. How's that? You know what I mean? Which makes that show hard to watch, in my opinion.
It's retirement football, right? So he was either going for $1 billion, whatever the dollars were, into the Middle East, but a different lifestyle for him. I think he has a lot of friends. He's brought friends over, other players to Miami. A lot of South Americans as well see Miami as like home, right? So like, I think for him it's a lifestyle choice. I don't, other than and it's like not very taxing or tiring. I think he's not going to get injured. He's having a good lifestyle. He's got his family there. He's an American. Look, what's not to love him? And also, I think most importantly, the way he's getting paid is interesting. He's getting paid through Apple. He's getting merchandise deals. He's like building the ecology or the ecosystem of soccer, football, in America. And I think that as a business owner, it's just better at that time of life to be a business owner than just being paid hard cold cash. And can you please do dinners every night and shake a bunch of hands? He's probably feeling he's a business owner, which I think that is exciting.
For you football fans out there, Messi is no Dennis Stewart, which you remember Dennis Stewart, or Johan Cruyff, for example. But I digress. When we come back, Stuart's co-founder of Current, Trevor Marshall, will be joining us, so stick around. Introducing event contracts from CME Group for individual investors who want a new, less complex way to trade some of the world's most recognized futures markets. They're smaller, lower cost, with predefined risk. Event contracts let you trade your views on daily up or down price moves in equities, gold, oil, and more. The markets you know and use every day. Take a position by choosing a side with event contracts from CME Group. Learn more at cmegroup.com/event contracts.
iConnections is the world's largest capital introduction platform in the alternative investment industry. They bring the asset management community together through a membership platform that lets allocators and managers meet and connect both physically and virtually. Over 3,000 allocators and 600 managers are part of the iConnections community, overseeing nearly $48 trillion and $16 trillion in assets, respectively. iConnections first came to our attention in 2020 during the first wave of the pandemic. That's when their first event, Funds for Food, became the largest virtual cap intro event in history. To date, they've donated nearly $2.5 million to charities. They are also the people behind the alternative investment industry's largest and most exciting in-person events. To find out more about iConnections events and members-only platform, visit iConnections.io.
What's up? Guy here. Did you know FactSet is the official data provider for risk reversal media? FactSet is the key to all of our analysis. It's not just charts. FactSet provides insight into the top headlines of the day, private markets, and sector-specific data. If you ever have issues, get help from their support team that is committed to your success. Visit FactSet.com to experience the power of FactSet and request a free trial and unlock access to the tools that matter most to you.
Hey, it's Dan here. Are you tired of struggling with your weight? I know I was. That's why I turned to Roe. They've developed a revolutionary medication approved by the FDA specifically for weight loss. It's paired with lifestyle coaching, so the weight comes off and stays off. I started with a free online visit and connected with a U.S. licensed healthcare professional. They prescribed the medication that's helped me drop 30 pounds in the last 4 months. And now Roe is offering a discount just for our listeners. To get our special offer, go to roe.co/tape. You'll pay just $99 for the first month and $145 per month thereafter. If prescribed, medication cost is separate. That's ro.co/tape. All right, welcome back to On the Tape. We are still joined by Stuart Sopp here, and we have his co-founder, CTO of Current, Trevor Marshall. Trevor, welcome to the pod.
Thank you very much.
You know, Trevor could be one of these actors. Like, he looks like
one of these actors?
Well, like that Ryan Gosling people and Ryan Reynolds. He's good looking. I mean,
Great
Stuart
looking man.
obviously is a handsome man. We talked about that last time. But I mean,
we did talk about that.
He's a good looking guy.
Trevor,
I didn't get a waiver for this, though.
You didn't get a waiver. You're also...
what does that even mean, get a waiver?
He's also the brains behind the operation.
Yeah, clearly.
Okay, so clearly. So he's got the looks and the brain. What do you do?
I got the brawn.
Oh, there we go. You know, it's funny. So this is kind of an interesting week in the stock market here. Like, a little volatility has moved back into it. We haven't seen a lot of it. We're getting towards the tag ends of S&P 500 earnings, and it's great to have you guys here today to talk about this a little bit, because it's funny, you know, like fintech was like the darling in the public markets during the pandemic, and we knew companies went public via SPAC, and it was just a pull forward, and there was a lot of really exciting things. But in the stock market this year, in a NASDAQ that's raging, right? The NASDAQ 100's up more than 40-some%. On a day like today, after PayPal just give their Q2 guidance, stock's down. I mean, stock's down a lot. It's trading near a 52-week lows. So as you guys are tracking this, you guys are building a company in the space, in the private markets. As you're tracking what's gone on in the public markets, is it just a disconnect between what investors' expectations were in 2020 and 2021, and just now, I guess, the logic that there's a lot more competition? We've seen a lot of behavior kind of moderate a little bit. Talk to me a little bit about what you guys are seeing, or what you take away from the public markets, at least the way investors are treating the guidance that PayPal just gave.
Yeah, I mean, I'd look to Stu for some of the investor sentiment side of things, but there are some fundamental shifts happening in payments that will be playing out over the next couple of years, but especially this move towards real-time, faster payments. It's a fundamental change. Like at the end of the day, we're moving from really a pull model, which is what Interchange and Visa, MasterCard, and a lot of other companies build on, towards a push model, where you're shifting liability in a way that should really erode some of the fundamental economics in the space. So this is a huge disruption that'll play out.
Who's most at risk? I mean, you just mentioned, obviously Visa and MasterCard. These are two massive market cap companies, and we talk about them all the time. They don't take credit risk. So when we have those sorts of periods, right, and we see the way some of the Money Center Banks Act or in American Express or something like that, they've been really stalwarts, if you will. Are they going to be faced with a lot of this disruption?
I think I've said it on this podcast or on OK Computer before, but Visa is my favorite fintech, and they've been ahead of this game actually in a pretty serious way. They have this whole network, Visa Direct, which is these card-to-card payments, and they've been thinking towards this for quite some time. And they're best positioned of a lot of the folks in the legacy space to take advantage of this. They did a partnership with PayPal and Venmo, and there's a lot more partners that are going to be announced on Visa Plus, where you can go across these different P2P apps on Visa rails. And so they saw this gap starting to form where the nature of payments is starting to shift, and they filled that with a product that, yes, might have slightly lower interchange economics and might be a bit of cannibalization of the main model, but it is now aligned with consumer expectations. Eventually, it'll be merchant expectations. A lot of money movement, and the payments business is going to be moving towards these types of push models.
I'm not asking you to play stock market here, but do you think the market understands what you just said? Because valuation on the back of something like that should be significantly higher than the current value. And they've always traded at somewhat of a premium valuation, but what you just described is cutting edge stuff.
Yeah, I think, the real economic weight of that only comes in a couple of years down the line. And how much do you discount that? I think is a good question when you're looking at the stock price today. But from my experience working with these networks, with these partners, it does seem like they have quite a big edge in the way that this is transitioning, especially this is just this month. We're moving away from ACH, which is all of the automated money movement within the US, towards FedNow, which is this real-time gross settlement system. And there's a lot of businesses that are built on that today.
So the valuation one's a good one. And Stu, maybe you could weigh in here a little bit, because when you think about like a PayPal, for instance, okay, here's a company that, trades well below a market multiple. It trades at 13 times. But to your point, and I think it's really interesting to frame it this way, Visa as your favorite fintech, it's a $500 billion market cap that trades at 15 times sales. There are not too many companies of that size that trade at a multiple of sales like that. 27 times earnings. It is trading like it's 2021 and it's the hottest fintech stock out there.
It is kind of, I think, Visa. I think for all the reasons that Trevor just mentioned. When it comes to PayPal, and it's a payments business, as maybe if we all agree on that, it helps. You got this interplay between banks and payment services, payment companies. And so in a high interest, high yield environment with the Fed raising rates and all that stuff, it favors banks. It deprioritizes payment companies, which are really sort of growth companies, right? So you spend, you got money in the bank and all that stuff. Inflation doesn't erode that. And so what we saw, I think, in the last couple of days is PayPal has leadership issues, which is one separate thing, right? So they've got like a transition thing going on. Two, we've just had Bill Ackman short the 30s and the 10s. We've got the Fed issuing $1.85 trillion of bonds. And so what you're seeing here is a massive overhang, a macro. I mean, I always draw it back to macro, but you see a massive macro overhang of bond issuance. And so it's moving back to this sort of narrative of, okay, can the Fed really hold inflation? Can they really cut rates? Can they really cut rates that much? And so when it comes to PayPal, they've done really well, I think, and sort of outperformed on some of their metrics and their earnings and all that other stuff. And they're doing their best in this transition period. However, they can't fight the macro headwind of what's just happened. And so now we're seeing, some of that hot money, there's a downtrend in PayPal, people bought it into the earnings. And then we've had this thing in the last 24 hours with the issuance and all that narrative, and now it's selling back off. So I think that's really what's happening to the payment companies. I don't think it's much more than that.
So, Trevor, this is my question to you. You're obviously Chief Technology Officer, so very specific vertical. But what Stuart was just talking about, when credit starts to make its way into your world, now credit hasn't been an issue for quite some time.
Yeah.
But the winds seem to be changing a little bit. Does that play into what you're doing on a day-to-day basis?
On a day-to-day basis, we do think about it, but I think the biggest factor of credit inside of payments is online with buy now, pay later integrations at the point of sale. And this is where PayPal is probably under the most threat, which is there are some extreme credible threats of like, why wouldn't I click that Affirm button, or why wouldn't I click that, Quad Pay Zip, button if the option gives me, 4 easy payments over X amount of time, right? And so the erosion of the value prop for payments and the way that credit intersects there, I think is powerful. That's not the business that we're in at Current. We're really about banking technology. We're really about having that relationship with the customer. But where I see credit coming into like PayPal's threat area is mostly on that point of sale. What are the ways you can get the value?
So let me try to elaborate on that, because yes, that's true. I totally understand it's a technology play, but as credit becomes a bigger issue, my sense is people will find you in that environment. They'll start to, where they have not had to move or search out, they will find themselves in an environment where they need to move and search. And I think that's why this credit environment, which I think we're on the brink of, works to your benefit.
And you mean deteriorating credit?
I mean specifically. No. Absolutely deteriorating.
Yeah.
Yeah, and I mean, this is where you have to go to places that are technology enabled like Current, because we can do the same services that a lot of banks can, but not charge fees for them because we don't have the same cost structures, right? So that macro environment pushes customers our way, absolutely. And it's been the main growth engine inside of banking for the last 2 or 3 years. Due to these factors, and also due to the customer expectation of convenience and being able to, get all of the services in one place. And that's really where we come in, and that's my day-to-day work. That's Stuart's day-to-day work.
I would also add that, we just launched this product called Build, which is a credit building product in deteriorating consumer credit. High inflation that's sticky, which everyone is saying, or at least some market pundits. I think building and maintaining credit levels in a particularly hard time is extremely valuable for a lot of people. A lot of people trying to make ends meet. And so, this product we just launched is doing extremely well, very timely for us. I know we've mentioned it before, but that's out and flourishing as we speak.
All right, I'm going to spice this up a little bit. I'm going to read a tweet, and I want to get your guys' reaction here.
Wait a second. Stop for 1 second.
Z, I'm sorry.
You said you're going to spice. It has not been spicy enough for you?
You're going to see where I'm going.
Okay, that's fine.
All right, so here's the tweet.
Wait a second. Is this going to piss me off? Just so I know
I hope
going
so.
in.
You already sound pissed off.
I'm in a great mood.
All right, so here's the tweet. This is from July 23rd. X is the future state of unlimited interactivity centered in audio, video, messaging, payments, banking, creating a global marketplace for ideas, goods, services, and opportunities. Powered by AI, X will connect us all in ways we're just beginning to imagine.
Vin Diesel.
Yeah.
No?
Yeah, I know. I think it is.
I think it's Vin Diesel.
Linda Yaccarino. She is the new CEO of X. What does that mean to you guys?
Is she really the CEO?
I don't know. But is that word salad? What is that? So you guys are building an app. You're doing a bunch of stuff that like some of those words that were strung together. I think you guys have probably strung them together a little bit better. What does that mean to you? What do you guys think of when you think of this kind of desire for a super app? Elon has mentioned this on many of occasions over the years. He looks over at WeChat and what's been able to cobble together in that regard there. How do you guys think about that? And do you think anyone will be successful in creating that sort of platform here in the U.S.?
I'll go back to like a macro view, which is you mentioned WeChat, which is a great product in a communist country, capitalist communist, whichever way you want to look at it. But it's command down, it's command control down. It's been told like this is how we're doing it. This is kind of how it is, and we just don't know what's happened in the back, in the back scene behind the curtain to enable that product to be really coagulated and consolidated into one place, meaning political party affiliation, and also just one place that you can spy on people, right? And so that maybe that's like part of the tailwind that they have. When you come to America, I think people want choice. We have a federal system. It's confusing and it's sort of cobbled together. 50 states kind of work together. We do this all the time in payments. It is not straightforward. And I think you just have a cultural / political system that's just totally different. And so I don't know if you're going to have the same kind of success having one-stop shop for everything. And it does feel kind of sort of big brother, communist, maybe socialist kind of feeling to it. It knows everything I'm doing. Maybe the value, maybe I'm not seeing the value. Maybe there's such a step up in value. Maybe there's 100x more value than I can actually see at this point if I plug into everything, whereby all those concerns are assuaged by the value that you get. But at this point in time, I mean, looking at Twitter or X, whatever I'm using now, I'm not seeing it at this point.
Well, I mean, the more things change, the more they stay the same. Citigroup tried to do effectively, be everything for everybody a couple decades ago. That didn't work out all that well.
No. So it worked out for a little bit too. Yeah.
For a little bit, and then obviously the world changed under their collective. You can't be everything for all people, in my opinion. So here's another question for you, Trevor. We spent a lot of time on Fast Money talking about AI, and you've seen some of these stocks have gone ballistic on the back or the hopes of AI. My sense is this is something you've worked on for a while, but how important is that technology? Have you embraced it, integrated it into what you're doing at current?
So a lot of the biggest gains that are happening now, from like a very practical standpoint, are mostly regarding customer servicing. So like, how do you handle an exception? Because that's where language comes most into. Like these things, while they are getting better at responding to multiple modes, whether it's audio, visual, they're still mostly trained around language concepts. And the language concepts that we have are, hey, where's my direct deposit? Or hey, I need to order a new card. These types of things. So that's where we're seeing it play out, and we have some integrations that we've launched and are continuing to launch that improve our servicing capabilities through that. So that's like the very first place. And I think that's the very first place for a lot of finance. But where it starts to get interesting is when you can start doing recommendations, right? Like all of this LLM stuff is autocomplete.
That's
which is,
what I was going to ask.
Given your financial universe, what comes next for you, right? So it's a natural extension of the way that technology is implemented. So that is something that I haven't seen yet. I think there's a lot of people who are pitching this, certainly, saying like, this is how it's going to work. I haven't seen an example of it yet, but it does feel a bit inevitable.
It's interesting. I need a new card. And so the next logical progression is we will furnish you with that, but does your husband need one? Do your children, are they of an age where so the machines or the intelligence can start to think ahead of the curve? Does that make sense?
Totally. I mean, it's autocomplete your finances, right? Like that's the concept of if you're trying to show what comes next for someone, this is the perfect technology for that.
So let's talk about as far as practical use cases right now. Those all make sense to us, but as a company that has to make decisions about how you deploy your resources, right? And when you think about what are you guys seeing as far as the cost of compute when you're doing these integrations, you're testing these sorts of things? Do you think that this is going to be something that will be an immediate return on investment, that sort of thing? Because I think there's just a lot of when guys started this conversation talking about what had has actually been imputed by the stock market values, we are pulling forward a lot of really great outcomes right now. So for a company like yours who are building technology, but you also are a user of a lot of technology, right? When you think about it right now, are you guys out there bidding for NVIDIA, like graphics chips?
Well,
you know what I mean?
I think one of the things that hasn't been fully absorbed is the nature of this technology, which is once a model's been trained, it's extremely low cost to use.
Right.
As opposed to if you're trying to do, let's say, video streaming or file storage, where the usage from a cloud cost and a margin perspective is pretty linear with the cost of that. With this technology, you're paying up front for all of the training, but then the usage of it is close to free. Because all you're doing is you're putting an input into a graph that's already been created. The cost goes into creating that graph. And then when you get the response out, it's like you're just,
So is that why, though, there's a
clicking
huge rush right now? Because obviously there's very few suppliers that actually have the chips that can go into these, supercomputers and can do this sort of training right now. And so you feel that it's just kind of the ones with the best, I guess, relationships with NVIDIA right now. And we saw who they were. You saw Microsoft, you saw Tesla, these companies and Google. They mentioned, I think, NVIDIA 37 times on their on their conference calls or something like that. Or they said AI combined 37 times, but they all mentioned NVIDIA by name. So I guess, the point here is that they get access to these chips. They get a lead, right, on deploying these sorts of models, and then they get the return on the back end in the not so distant future.
Yeah, I mean, it's whoever has the best model in theory in a perfectly rational environment wins. But I think it's more than that, which is you need to have the distribution of the model. So I would be looking at the cloud providers. Google is probably best positioned out of anyone to do this at scale, which is it has to be integrated with the rest of your product suite. Because at the end of the day, it's going to be an engineer making a decision of how do I interact with this thing. Even if that interaction might be cheap, it needs to be easy, right? And it's not particularly difficult to distribute this in one place. Like OpenAI is sort of independent, pseudo Microsoft. But I think GCP and the way that they can integrate that sort of into their holistic product offering is another component besides just the model training firepower that you have for these chips. But that's no doubt super important.
So 2 weeks ago, Microsoft announced the pricing of their Copilot, right? So this was, this is their productivity suite that's in using, a bunch of these AI tools. And, the stock, and we talked about it last week on the pod, rallied $130 billion in market cap. It rallied 5% in a straight line intraday. Now, it gave a lot of that back over the next couple of days, and now it's much lower. But when you saw that pricing, does you guys, again, you are licensing these sorts of technologies at $30 a seat, I think is what they said, up from 10 prior. Do you guys take pause at some of this? Will you guys be deploying these types of tools across hundreds or eventually thousands of your employees, or will they just be a kind of narrow focus among the, specific users at your firm?
Well, there's some pretty immediate tools that are pretty useful. This is a very text specific thing, but when you're writing code, you're doing that inside of another program, and that program that we happen to use is called IntelliJ. But there's tons of these things. Microsoft has their own, Visual Studio. There's quite a lot of these what are IDEs. The integration there for autocomplete on code is going to be a big productivity increase for developers. And that's where Copilot was really tested first, was integrated with Microsoft's acquisition of GitHub and sort of really in the coding world. And it's a very structured language. It's one of the most natural things to benefit from this type of technology. So I think we'll see some pretty big productivity gains, but you have to balance that with security concerns about can I let my code go out? If someone's auto-completing, it means that I'm sending sort of what I'm typing out to a server somewhere because that model isn't living on my machine. I mean, there's different ways you can do it, but I think once you get around, because we work in a highly technical, compliance regulated space, PCI compliant, SOC 2, as long as we can navigate that appropriately, I think we're going to be seeing a lot of productivity just within our own company.
When I've talked to Trevor, 10x engineers can be 100x engineers, really, really productive.
Based on just
some of this, some of your best engineers are just phenomenal. And so that has its own pay graph and structure and future curve. And then For a lot of people that were sort of filling in the blanks and weren't that technical, I think that those jobs are like at risk. So there's like a balance, right? There's maybe a power law sort of happening here through engineering resourcing. From a customer or member experience standpoint, obviously there's a lot of language. We're talking to customers in the phone, we're talking to customers in chatbots, we're talking to customers all over the place in disputes and fraud and all this other stuff. And so there is a natural cost saving and productivity gain there. For many companies have been using chatbots for 10 years, but we're talking like another level above, an order of magnitude of competency. Even telephone calls now can sound human-like from AI. And can be on the fly answering questions as long as you've got all your data uploaded. I think I said this on our last podcast, is the companies that have their data in order, that are connected to the cloud providers, that are best in class with the AI and all the compute, are the ones that are going to win. That's how it's going to work, or at least have the best cost savings or the best productivity for those companies.
So if you're nimble enough, which you are, and then able to integrate a technology which takes a 10x programmer to a 100x, that gives you tremendous advantage. I totally understand that. The existential risk, it seems to me, not only on a business side, but on a technology side, and this is just me spitballing, if an Amazon decides, all right, we're getting into this space and we're going to throw these resources at it, is that something that concerns you, or do you feel you're sort of well-suited, well-armored to take on something like that?
We'll buy tools from anyone. Right. And so a lot of these cloud providers, they are the things that we build our product out of. They're not building the businesses that we care about. They're part of our cost basis. And if Amazon comes out with better tools, we'll use that. We actually use AWS for a couple of things at Current. We use GCP for most things, but we use AWS as well for places that they are quite good at. So I think competition is awesome for this. We're going to get the best models. In the AI front, like we'll get the best models at the best price. And there's so many specializations that already are coming out depending on how they're being trained. So
Stu, I know you look at the public markets just as a bit of a hobby, and I know you started there anyway. What do you think, if you are like kind of just a naysayer, is at least on the price action of these like $1 trillion market cap companies that have gained a couple $1 trillion in market cap among them because of just excitement in and around the secular movement, which is it's happening, okay? But again, my point is, in the near term, it feels like it's kind of pulled forward a lot of excitement, and we really won't see this drop to the bottom line, at least and also in these early guys, for probably a couple quarters. And that's one of the reasons why Microsoft is down 10% over the last 2 weeks, okay? Because they guided, and it wasn't that people didn't get the payoff, and I don't know why they would have. But do you guys think right now is if you can kind of take out some of the noise, okay, and take a little of the froth out of this market a little bit, are these like trends that you want to invest in Microsoft and Google and Amazon? Like once the fever breaks a little bit, is this going to be a multi-year thing for these guys?
Yeah, 100%. For me, I think multi-year, man, I can't even do that anymore. Yeah. But I could do a year out maybe now. Ask me 10 years ago, I would have said multi-year.
Yeah.
But I think right now, everything you said kind of checks with us, or at least with me, is that we've pulled forward way too. It's been a hype cycle. It's very, very frothy. Yeah. That the NVIDIA CEO is a great salesman, and so he gets everyone really excited about what's happening. But we're not going to see immediate returns. Look at our company, right? We're just getting around to some of this stuff. Maybe we see some gains, some productivity gains this year. Majority would probably be next year, but that would be it for a while, right? Because then you'd need like another order of magnitude of innovation around all these different use cases and niche things that Trevor's saying, and that takes time to get to. So when it comes to price action, I think it's still macro. I think it's still the debt side of things. I think this is going to pull back even more, and then you want to start buying at the appropriate price. Price is just, what you're going to get out over how many years pull forward, right? And so maybe we pull that back in, the price comes off, and then it's time to get in.
And also, like, this technology is fundamentally deflationary.
Yeah.
Right? Yeah. And so it's 100%. Like, if you're looking at, you said it yourself, okay, Copilot, $30 a seat per month, and this does 3 times what the other person was doing?
Yeah.
Like, how are you going to, has Microsoft already been valued for all, if they're charging $30 a month, because that's how cheap the technology
but I also
is.
say for their own engineers.
Yeah.
So Google, Microsoft, Amazon, they have been the main purveyors of engineers for the last 10, 15 years. And all of a sudden they don't need them. Why do they need all
Yeah,
these
but that
engines?
was the thing that I just found astounding is Guy and I were doing one of our shows and that headline came out and the stock went up 5%. And this is a $2.5 trillion market cap company. And Amy Hood, the CFO of the company, I think the week earlier was talking about before they had the pricing out of she said this is going to be our fastest business at $10 billion in sales ever. So I did that $10 billion and then I looked at the market cap gain and I'm like, it's trading at 13 times sales, the sales that they haven't even, registered yet. You know what I'm saying? And you don't know what that's going to cannibalize. Does that come at the expense of something? You guys negotiate. You just said, we're going to get the best stuff at the best price. So you may say, okay, we'll take 150 of those seats, but we're going to actually need to have better pricing on this stuff over here. So I just think the market's lost their minds about this stuff. And I will tell you, I mean, to me, the best way to play this is if we had the QQQ, the NASDAQ 100, which we know that those top 8 stocks, that all of them are going to be, if they're not exposed to this multi-year trend, okay, they will be. And I'll throw Apple in there at some point too, right? That's the way to play it because those top 8 stocks make up 50% of the QQQ. But you can't buy it when it's up like this before we even know how it's all going to be, in my opinion, how it's going to play out, especially in the middle of a mania.
Here's a question for you. This is for Trevor. Erin works here. She does a great job. People know they see her. I like her. People see Stuart. I like him. So I understand how you would acquire clients based on those things, those human things. My question to Trevor is, does client acquisition come in the form of technology? Can you do things on the technology side to help with client acquisition?
I think that's almost our entire business, which is, we are creating products that need to sell themselves. Yes, we market and we go and we get awareness and these things, but at the end of the day, we are building something that's more valuable to our customers, and we're doing that with technology, and that's the acquisition.
Yeah. So marketing has been an interesting spot for at least our industry for the last couple of years. So ever evolving. The biggest thing that happened to us, our industry, was the Apple Facebook privacy dispute a couple of years ago, and so tracking across multiple platforms was very hard. It was hard to personalize advertisements to particular segments, and of course, it does look like Apple is trying to cannibalize or internalize that functionality and eventually launch their own ad network, right? So if that happens, I would be a buyer of Apple because we'd definitely be marketing on that platform in a broader way than we are right now. But at this point, it's actually regressed a little bit in terms of like how you're approaching the top of the funnel marketing. But we are using things like digital TV, streaming TV that's digital, like Hulu, Netflix. So we can be quite targeted. It's not like broadcast, so we can be targeted. And so then the interplay of that with various digital channels and showing the value at different stages of people's lives and things like that and understanding exactly where their intent is how we market. So it's extremely in-depth, complicated stuff. You use a variety of tools to do it.
Well, it's interesting that you mentioned, Apple's got 2 billion iOS install base, right? And you think about the power of that, and they cut with the ATT, they cut a lot of ties to a lot of folks who used to like to kind of track things across their hardware, right, and their platform. And then you think about Amazon has this huge advertising business that's just growing. Netflix just turned on advertising. Uber's results, I don't know if you saw it earlier in the week, they're talking about it. When you open your Uber app, all of a sudden you're seeing ads in there, and they're actually pretty well placed. You know what I mean? So, for me, the ad stuff is like the high margin stuff for a company like Amazon, and Apple's business will be absolutely huge. All right, guys. Well, this was really good.
Hold on, before we get out of here, and you might edit this out,
Hopefully.
so nobody would know if you did it.
Yeah.
But I'll say this. So Stuart just said something about privacy, right? Yeah. And then nobody even I batted my eyes, but you go out to the Hamptons out there east, and you see those big things. They're called privet hedges. That's to keep things private from people.
Yeah.
We use the word private here in the United States, but he's talking privacy. That just shows you the difference between your upbringing and my upbringing. I'm an animal and you're sophisticated. Anyway, I just thought I'd get that in.
Yeah, we're definitely going to cut that out. All right, Trevor Marshall and Stuart Sopp, thanks for joining us on the tape.
Thanks.